Good morning. How are you, everybody? Hello, everybody. Today, I am I am Abdullah Suderi, at compliance officer at Muscat Insurance Company. Today, we will meet together. Mr. Krishnan, he is deputy CEO at Muscat Insurance Company. Mrs. Alina, she is acting CFO. Also, Wahida Batan, she is board secretary.
Good morning and welcome to all of you. Thank you very much for joining us. It's a pleasure to be with you to present our Q2 financials. I represent Heading Muscat Insurance Company. I'll just give a brief intro of the company overview and then hand it over to our Deputy CFO, Alina, to give the financials. In the name of God and thanking His Majesty Board for the guidances, the trust of the shareholders and investors in Muscat Insurance Company. And last but not the least, my team, who has been the source of strength and inspiration for making all the turnaround that I wanted to make in the company and make it a resounding success in coming years. I start presenting this Q2 financials overview of the company, Muscat Insurance Company. The market is lot of opportunities exist in Oman. And in the last 1 year, the major initiatives that we have taken as management has seen fruits. We've been able to grow and we've been able to make a turnaround. The market sentiments are very positive. The profits for Q1 and Q2 show testament to the performance that the company has made. Q2 in particular, the entire industry has had challenges, largely because of the NatCat events that happened in April, March, and somewhere 1 or 2 sporadic incidents in February. But more specifically, the April incident has created a real dent in the insurance industry, not just for 1 or 2 companies, but the entire industry, which makes the reinsurance positions for various companies a little challenging. But for that little dent, I think the industry overall has been performing reasonably good. 2 specific lines of business, which perhaps the entire industry, the insurance diaspora think tank, the regulator, and with the support of the government, which they are trying to see what improvements can be brought in. We expect that once those steps come in way, it would help the industry to further hasten the process of a better performance on the medical and the motor sector. Now, Q2 for Muscat Insurance has been good. It could have been even better, but for as I said, the NatCat losses that happened in the motor specifically. The general business have significantly contributed to the bottom line. As the head of a company, the ideal mix that I would have wanted for any company to stand, exist, sustain, and prosper is perfectly matching in Muscat Insurance's portfolio. General portfolio consists of 68% of the total business. Motor, we have consciously, because of the prevailing factors that I explained to you, the challenges in the pricing, market shares, and the existing NatCat scenarios, we consciously are a bit tightening the underwriting controls on the motor, and still it is representing 17% of the portfolio. Medical and life represents 15% of the portfolio, where the profit is being seen. Largely, we are focusing to take extra efforts to convert on the reinsurance side we gather as much momentum as we wanted to increase the retention and contribute to the bottom line. IFRS 17 provisions that came into effect quite recently in the last 2 quarters has made the insurance company as well as the clients realize the importance of paying the premium on time. And we have been quite successful in enabling our partners understand the reality, and it does contribute immensely to the bottom line. We have made a profit after tax in Q2 of 89,000, which I would leave it to Ms. Alina to detail. In terms of growth, we have grown 22%. Largely on the gender, as I said, we are focusing more on the areas where we want to deliver profits and show improved bottom line. Our strategies have all been aligned the next 2-3 years geared towards improving the portfolios which contribute directly to the bottom line. With these few words, I hand it over to Ms. Alina to take us through in detail the financials. I would invite any questions that you may have at your choice in intervening whenever you have, or for ease, if you reserve your questions at the end, it will be easier for us to clarify. Thank you very much.
Hope you can see the slides. Deputy CEO has given an introduction about the company as well as the financial performance. We will go through in detail the financial performance highlights, financial position, investment details, and key ratios for the period ended 30th June 2024. Starting with the financial performance of the company, we have given a comparison from 2022 till H1 2024 to understand the growth of the company. From 22, the gross premium or insurance revenue, the terms are IFRS 4 has changed to IFRS 17. We are using gross premium as per IFRS 4 and IFRS 17. There are certain change in terminologies that is to insurance revenue. The insurance revenue is for 2023 is 20.7 million compared to 15.6 million in 2022, which has a massive growth in 23. In H1 2024, it is 10.6 million compared to 8.6 million in H1 2023, which is having approximately 22-23% growth. We will go in detail in the coming slides. We'll give an introduction about the performance first. The underwriting contribution or the net insurance service result for H1 2024 is 686,000 loss compared to 583,000 in H1 2023. In 2023 year end, it was 995,000 loss compared to 287,000 in 2022. Coming to net investment income, the net investment income is 1.15 million for the first 6 months compared to 623,000. In 2023, it was 1.4 million compared to 2.5 million in 2022. The reason for the major reason for the difference in 23 and 22 is because of the unrealized income, which we have booked mainly from our HSBC shares in 2022. And we have realized our HSBC shares in 2023, and we have approximately achieved like 500,000 profit from the realization of HSBC shares. The profit or loss after tax in H1 2024 or first half year 2024 is 89,000 compared to 323,000 loss in the same period last year. In 2023, it was 469,000 loss compared to 839,000 profit in 2022. We will go through the detailed performance or financial highlights for the period ended 30th June 2024 compared to 30th June 2023. The insurance revenue is 10.6 million compared to 8.6 million in 2023, which is 23% growth. This is mainly from our fire as well as the engineering class of business. As a management strategy, the overall diversification has done from motor. We have diversified our growth to other segments of business. So accordingly, the premium also has increased approximately by 24%. If you're seeing the insurance services expenses, there is an increase of approximately 25%. It is mainly because of the motor loss claims ratio. We had tremendous growth in the previous year motor premium, which has resulted in the claims ratio, and we have taken necessary actions and steps to mitigate the losses in the coming quarters. So hopefully there will be a positive result by year end 2024. Coming to insurance service results, it is 686,000 compared to 583,000. In spite of having the huge claim ratio, we were able to manage the profit insurance service results to 17.7% compared to previous year. The investment income for the current year is 1.1 million in comparison to 623,000. Approximately 500 to 600,000 increase, which is 85% growth in the investment income. It is mainly coming out of the unrealized income, 300,000 from the equity shares, as well as from our fixed income investments, which we have done during the previous year. So that is gaining investment income for the current year, 2024. The insurance finance expenses are slightly reduced, and the insurance and finance results is 386,000 compared to 64,000 loss in previous year. As we have already seen, the investment income has contributed largely to the insurance and investment results. The other operating expenses has also slightly reduced compared to previous year. It is because of the management actions to reduce the overheads and contribute to the profit for the period. The profit or loss after tax is 89,000 compared to 323,000 loss for the previous year. In spite of having huge claims ratio for the previous year, the management has taken necessary actions. So it has shown the positive impact of 89,000 for the first half year ended 2020. The earning per share is 0.008 compared to loss of 0.029 in the previous year, 2023. Now coming to the financial position of MIC as at 30th June 2024 compared to 31st December 2023. The paid up share capital remains the same, which is 11 million for the same period last year as well. The total equity is 17.57 compared to 17.485, which is slightly increased due to the increase for the period, increase in profit during the period. The total liabilities is 25.8 million compared to 25.9 million, slightly reduced. The total assets remains almost same, which is 43 million, and the total investments 28.776 compared to 29.455, slightly reduced due to the reduction in the cash and bank balances, which has been utilized for the current year expenses. The insurance and reinsurance contract for the period is 12.3 million compared to 11.4 million. And the insurance and reinsurance contract liabilities is 20 million compared to 19.9 million for the previous period. The net asset per share has slightly improved from 1.586 to 1.594 for the current period. Now coming to the investment mix. Our investment mix, it's largely on current year, it is largely on 51% on bank balances and fixed deposits, which has contributed to our investment income as well. Approximately 100% increase in investment income has generated during the period. Our investment property stands at 29%, bonds 7%, and equities 13%. If you're comparing with H1 2023, it was only 41% in bank balances and fixed deposits. Investment properties, it was 32%, and equities are slightly reduced due to the liquidation or realization of HSBC shares. Now coming to key ratios, we have already discussed net assets per share has slightly improved from 2023 year end, that is 1.586. Improved to 1.594, and the earning per share has improved to 1.008 compared to the loss of 0.029 in the previous half year in 2023. This is the summary of our financial performance and highlights for the period. So if you have any questions or queries regarding any of the figures or any of the discussions which we have done, you can please let us know. We are happy to answer of any questions.
Hello.
Hello. Yes.
Hello, sir.
Hi, good morning. Can you hear me?
Very.
Yeah. I'm Joyce from United Securities. Just a few questions on, you said you have a shift in strategy. You are moving from motor to more into fire and engineering. So can you please elaborate what are the reasons that led to this conscious decision in shift in strategy, as well as what are the opportunities that you are seeing in fire and engineering business?
Certainly, sir. Thank you very much for your question. As I said, motor as a business, both in Oman as well as in UAE, has been under stress owing to various factors. One is pricing factor, market share war, price war, the increasing inflation in the claims costs, the societal responsibility to take care of the losses that happen, which is beyond the control of, let's say, the diaspora, which is operating in the market. All these can be addressed together as insurance community with the regulator for pricing control on, let's say, various underwriting and claims management functions. So, as an industry, until it resolves and moves to a more amenable way to contribute to the bottom line, the conscious strategy of most of the insurers within the market, and more particularly after this devastating, unprecedented, unexpected 1 in 75-year rain that happened in the UAE and the Oman in April, and the market capacity is crippling. The market per se must be willing to accept the increase in motor pricing, or the insurance community as a whole, with the support of the regulator, should be putting up the price. Last time that motor prices have been increased was in 2016. And we are in 2024. We know the inflation, we know the supply chain impact, the increase in cost of labors, delay in parts, and the consequent impact of the increase in compensation on motor claims. Therefore, while actions are taken by all the players in the market with the support of regulator and Oman Insurance Association representing for a complete whole-scale actuarial study of the motor portfolio, and the expected objective and the outcome is to arrive at the burning cost on motor, and therefore all the insurance company will stay put at the price below which nobody will be selling. So that is a process which is underway, and we expect it to take perhaps 3 to 6 months. Therefore, the main focus should be and would be henceforth as a strategy which I adopted, is to grow on the general portfolio. General portfolio, when I say general portfolio, it will be a composition of the, let's say, the SME kind of business, which should remain 50% of your total book, and 30%, 35% will be the mid to high range, and 10 to 15% should be the highly volatile big businesses. So this 50%, as I said, will give you a complete flexibility of the fundamental sustainable growth of any insurance company, and that comes from general insurance business. Largely, the fire engineering business have been stable, and in the last 1.5 years, where we are seeing a good uptake in the revival and uptake of the projects that are getting announced, approved with the support of government. We are seeing quite a lot of projects that are coming up compared to, let's say, 1-2 years ago. The economy is moving in a positive direction. More engineering projects are underway, more requests are flowing in, referrals are flowing in, and we are converting. And with the advent of the steps that we consciously took to address the 3 top priorities of any company: people, process, and the systems, we are hearing very good sentiments, and thanks to the support of the insurance broker fraternity and the direct claims fraternity, I meet quite a lot of people on a regular basis to gauge and assess the strategies that we are taking is well received, or any course corrections are required. I see they have received it well, and I see the positive growth henceforth on the bottom line can add up from the general lines of business. Albeit to say that you have to be a player in motor, so much so that you don't overly exposed to motor or medical, for instance, or if you write, we consciously write at a portfolio approach for achieving the bottom line from the particular portfolio of a client or the broker. I hope I answered your question.
Thanks very much. So your focus will be primarily on general insurance. So can you give us some insights as to what's the average claims ratio for this segment? As well as on the nature of the business. On one, is it a fronting side of the business that you are more focusing on, or is it like you're actually taking significant risk in the portfolio?
We are a player in this market willing to have a skin in the game. Therefore, the question of pure fronting does not arise, and increasingly it is about improving our retention, contributing to the net earned profit, and therefore the bottom line. Now, you're talking about the loss ratio of the segment generally. Loss ratio of the segment overall, if you see, let's say, the biggest contributor in general will be a fire engineering, as you rightly asked. So that hovers around, if I take a fire, for instance, Oman is in a very, let's say, balanced position, if I may say. In UAE, there are quite a lot of high-rise structures with, let's say, the kind of material that are being used in the high-level high-rise construction, contributing to higher incidence of fires and severity of losses. Fortunately, it's not the case in Oman. You are not seeing quite a lot of, or we don't generally see most of skyscrapers here, which means it's a bit stable plane, and the portfolios in property has been profitable fairly for most insurance companies. One area that bothers Oman and increasingly in UAE also in the last few years, more particularly in 2023, has been this NatCat. It will remain. This gets addressed. I think regulator is wanted to move towards capital pool reinsurance market is involved in it. Gave also there was discussions and a plan ahead of how we handle this cap pool. So once these things come, the NatCat gets addressed automatically, and the new capital will flow into the market to help sustain, stabilize, and surge ahead. So in terms of loss ratio, overall industry, I expect it to be around 30 to 40%, but albeit when huge catastrophes happen, it will swing this way and that way. But largely, it is stable.
Okay. Okay. Right. Thank you. And what was your loss ratio for the last 2 quarters, first quarter and second quarter? Because what I'm seeing is first quarter was good, and second quarter, there was significant challenges that you have observed. So, can you share what are the major challenges that we have seen in the second quarter of this year, and how are things panning out for the remaining part of the year?
See, your observation is absolutely correct. The loss ratios have slightly deteriorated compared to Q1, purely owing to this motor portfolio, which I've been emphasizing clearly from the outset. General has been really performing profitably, and that is the reason I wanted to grow in the general portfolio. Motor portfolio has had a dent because of few reasons. I mean, it's a combination of several factors, if I may say, right from pricing to the choosing of the risk and the increasing claims severity, the typical total losses that arise when the NatCat event happens, or the global environment contributing to the supply chain, leading to increasing cost, causing delay compensations on motor claims to increase, and most importantly, the compensations and the inflation in the cost of court compensations and injury-related cases of late, and then let's say the litigation of one stage of the court to other stage of the court to the final stage of the court, and again coming back again to the appeal section being referred. So all these things increase and contribute directly to the increase in the claims cost. On the loss ratio per se, maybe I leave it to you. You have the figures.
Specifically for motor, it is more than 100% in the second quarter compared to, it is slightly less compared to in the first quarter. So it has gone little slightly more in 104% in the second quarter, specifically for motor loss ratio.
In fact, our general portfolio is 17% loss ratio.
We see
Overall, it's 94.
it is like 94%. Only like motor specifically, it has gone more than 100%.
Okay. Overall, 94% for
the
the
question?
first half, right? Overall, 94% for the first half.
Yeah.
Is that correct?
Yeah.
Okay. Okay. Yeah, fine. And what was the combined ratio, if you can share that?
Yeah, the expenses part of it.
It will be approximately like 20% more with this.
Yeah, our horrors have been, we are consciously looking at reducing the expenses to increase the efficiency. So that, yes, it is, once it is 94%, I see a point in the margin that you have for the overhead expenses. But you see, that's exactly the reason where when your journal is going at 17% loss ratio, more retention will contribute to your profits, and therefore it will help sustain when your loss-making portfolio on motor is handled better with better underwriting controls and claims management functions. We are talking closely with the regulator as well as Oman Insurance Association. We are representing the real pain points of the insurance industry. And hopefully when it gets addressed, it will be just in time to have a perfect reversal. And when it comes to motor, we are not alone in the game. Everybody sails in the same boat. So I think once these changes come into place, when the actuarial report gets published by the firm which the Oman Insurance Association is working with, it will have a very significant positive impact if all insurance companies are adopting to freeze the rate with the blessings of support of the regulator. It will help regularize the portfolio.
Okay. So, see, we are talking about almost 115% is the combined ratio right now. What's your strategies to achieve combined ratio less than 100%?
As I said, compared to 2023 motor portfolio, which we have written last year, the budgeted motor portfolio for motor, consciously, we have taken a lesser than what we have completed in motor in view of various reasons that I mentioned. So that when you are curtailing writing business in a controlled manner, and improving the people, recruitment of people have been done in various quarters, improvement in system control has been done, improvement in processes have been done. So all these things you have seen in Q1 improvement compared to end of year 2023, or you can see the movement. But the unexpected magnitude of the severity of losses resulting from the catastrophe is beyond the control of any person, any company. So that wavering, what you call volatility will happen in motor. But by and large, if you see the graph, with these controls and the conscious plan to reduce the line of business which hits your bottom line, will over a period of time ensure a smoother curve. What has been written previously, in insurance policies, it will have an impact of 12 to 18 months for it to mature. So that impact, it should be given its time to sort of mature. But the new businesses that are being written, let's say past January, the loss ratios which are being monitored on a constant basis of the books that are being concentrated to write in motor and medical particularly, it is positive. So what is seen is a result of what perhaps has been written before with the corrections in the process, systems, and the focus on the controls that we have employed is expected to see a positive result going forward.
Understood.
And you have seen on the overhead expenses also, I specifically mentioned there is a very conscious effort to reduce the overheads. So one combined with reduction in cost by way of increasing the efficiency. Before that is what exactly the company aspires to grow, which area we want to lay our hands in, where we don't want to overly lay our, let's say, emphasis, and which might hurt us any point in time. So these strategies, once it's clear, it's about just realizing the time to strategize and position your market to get the best out of it. So which has already happened the last 6 to 8 months. And as I said, the feedback from the insurance community whom we meet on a regular basis has been quite positive, quite supportive, and that has helped us in sort of smoothing out the let's say the accumulated earlier books that we have written by mingling up with new quality good business, consciously reducing the let's say the top line for loss-making portfolios, and thereby on the contrary increasing the profit-making portfolios significantly.
Understood. Very clear. Another question that I have is on your investment strategy. What I've seen is you've been reducing on your equity investments, and you're increasing on the fixed income portfolio. So, what's the kind of yields are we getting on this fixed income portfolio?
I will just answer first part of it and hand it over to my CFO, Deputy CFO, Alina. See, our strategy has been to fairly have a stable, sustainable income. I'll be to say that she mentioned about HSBC shares, and that got significantly invested at a better rate where we could fetch FD that point in time, and it's creating a result. The Fed announcement that is expected and going forward, FD rates we are closely monitoring, and you must be aware the FD rates which are currently available is not on the lines of what we had until perhaps end of December. So capitalizing on a stable, sustainable revenue possibility is our key goal. The current global economic environment in which it is moving, we are watching to sort of not expose ourselves in certain equities which could potentially be highly volatile, so as not to negatively contribute on this. I leave it to her to answer on the yield question.
Like as our deputy CFO has rightly mentioned, our main objective is to have a stable income. And specifically for last year, we had substantial investments in HSBC shares. And as part of the merger with Bank Sohar, we had the option to realize the cash option, which has given a good return or realization of HSBC shares, which has resulted in the decrease in equities. So while comparing it with H1 2023, that is the major reason in the decrease in the equities. And same time, actually, we had the option compared to current year, same last year, we had the option to have a like really good percentage of good interest income from the fixed deposits, which we from the whatever earned from out of the HSBC shares, we were able to deposit in the for long period, which has generated a higher income in the current year. So comparing to previous year, like we can easily say like approximately 100% increase in the fixed income only because of the rates which has resulted, which has also increase in rates in the previous year. So approximately we used to have like 6 to 6.5% yield, specifically from fixed deposits. And compared to like fixed deposits or other overall other investment properties as well as equities is overall contributing only 40%. So major amount is coming from the fixed income, which is contributing approximately 6 to 6.5%.
Okay, ma'am. And for how long, are you locking this rates? Are there any maturities coming up over the next 12 months?
Actually, the maturity period will be varying from like 1 to 3 years. But as I told you, like we had majority of the investments which we had renewed in the previous year, which will be coming for maturity only in the next, not next year, like maybe within 2 years.
Basically, we saw the rates on FD probably will be dropping in the near future. So we wanted to block when the rate is quite high so that we get a stable, sustainable income in the wake of various global scenarios that we are seeing, and blocked it for longer term.
I got it. Thank you. And what's your strategy in equity portfolio? Will you be just passively managing this without much of any changes, or are you planning for an active portfolio?
In one word, if I have to answer, watchful and being opportunistic. So where there is an opportunity, we want to venture without perhaps being overly aggressive, which would affect the returns and less of volatility. So being a bit cautious in having a stable, sustainable income approach at the moment, in the view of so many uncertainties prevailing around.
Got it. And that's it from my side. Thank you very much for answering the questions and for the presentation.
Kind of you, Mr. George, for the questions. Thank you very much. Any further questions, Mr. Ishwar? We're happy to take any further questions.
Thank you for all for attendance and attention.
There are no
We have
other
to-
questions. We thank you everyone. Thanks everyone for the support, and we look forward to your continuation. Sorry.
No, we have to close the meeting after. Thank you for all.
Thank you.
Thank you, everyone.